Okay, peeps, welcome back. So, we're going to be talking about the FOMC meeting results today and what we expect going forward. Let's get it. So, the first thing that I want to mention in this video before we get started is that basically the summarization of what Jerome Powell said this morning, who's the chairman of the Federal Reserve, is that the member or committee members, basically the other Fed presidents, they've all decided in tandem with each other that they are pretty much done raising rates at this point. The decision is official. They're not going to raise rates anymore. Jay Powell said something very interesting during the meeting that he had. I believe it was at the White House, and there was like a bunch of reporters there and stuff that were asking questions, but there was something that stood out that he said that I found to be quite interesting. And he said that we're not necessarily going to declare victory yet, or something along those lines, meaning that they're not 100% sure that inflation is actually sustainably down. Of course, that's how the Fed's going to see things. If you understand the market psychology of traders and investors and economics, you would understand the reason why they could really never come out and be like, "Oh yeah, we're certain that inflation is going to be down permanently now." They're never going to be able to say that because they're not going to be sure until it gets to 2%. Another thing that Powell said that I thought was definitely very bullish is that he said that they're not going to wait until inflation gets to 2% to begin cutting rates, or to basically they're not going to continue to hike and hold rates until the inflation rate gets to 2%, because of the lagging effect. So that's good that the Fed is keeping that in mind. So with that being said, we're going to take a look at some different implications of the markets, and then we'll talk about what we expect going forward. So basically, we're going to take a look at the effects of what has happened to the market since the FOMC meeting. As you guys can see, the market is up massively. SPX is up almost a whopping 50 points today. So if I just can actually get it to show up here for y'all. This is on the 4-hourly chart. So this basically covers pretty much almost all of today's trading sessions. You're talking about 1.41%. That's a big day in markets. Just so you all know, if we get at least a 1% move, that is considered to be large. Somewhere between 2 to 5% is considered to be really huge. You can see all the different indices are up. The Russell is up even bigger than the other indices. We have said that we're more bullish on the Russell because it's lower. We're further away from the highs than the other indices. We got a nearly 4% move on the day. Something that's really important that I want to point out is the massive drop in yields here. You can see just by looking at these that these have dropped huge. I mean, you get between a 4 to 6% drop. So that indicates that there is some kind of shift coming with the Fed. We'll talk about that a little bit later about what to expect with rate cuts and all that. But yeah, you can see that it hasn't uninverted yet, but the rates have dropped substantially. They're getting to a point where they're about to be below 4%. Everything looks good. The VIX hasn't spiked massively, which is a good sign. For the CPI, we did not cover that, but basically it was basically down and flat. So core didn't really change. It was stagnant, and then headline inflation came down. So that's good. It didn't go up, because if it went up, then there's a possibility the Fed might have to raise rates again, which would cause the markets to dump, and we'd be back on the bear market mentality of, oh, is the market going to dump or is it going to go up? So with that being said, for those of you guys in Coney, you can see that Coney's up a massive almost 7% today. It's pretty incredible. This thing's still running like a beast. So you can see pretty much at a bird's eye view glance across the board, it's basically almost nothing but all green in the markets today. This would be your smaller cap growth stocks. Some of these are kind of mid cap, I would say, but mostly small cap. So with that being said, we'll take a look at some of the more important things here. So I actually want to scroll out here to the weekly. If you guys have been following us on X, you'll see for yourself. We are currently at all-time highs right now on the NASDAQ. As you can see here, you see this little wick. It is actually above this wick down here where price currently is. So that is considered to be a new all-time high. The S&P is getting very close. We're literally, I would say, roughly about 40 to 50 points, somewhere in there from the all-time highs on the S&P. Russell 2000 still has a ways to go. We haven't broken out of this resistance yet, which is at 2000. But if we do, then the next resistance would be roughly about 2130. And the Dow Jones is also clearly at all-time highs right now, as you guys can see. This is a big deal. We have not seen all-time highs in the markets for basically about 2 years. So this is history in the making. Stocks are going to the moon. Indices are going to the moon. I mean, I could even show you guys some of these futures trades that we could have taken this morning on the FOMC meeting, but we chose not to because, yeah, trading in FOMC news or the CPI could really be dangerous. But you guys can see these massive, massive moves. Imagine if I had been short here and got squeezed, would have gotten absolutely destroyed on that trade. So that's the reason we tend to stay away from it, but could have made some serious money. I mean, silver had a massive dollar move. That's like a $5,000 profit. You guys can see that crypto is also up mostly as a result of the FOMC meeting. So, I mean, yeah, it's looking pretty good. We did actually buy some HZen this morning because BCHG is just not coming down like we expected. So we put a little bit into HZen. But the more important things that I'd like to talk with you guys about here is basically the Fed funds rate. So if we take a look at the Fed funds rate, as we've told you guys before, anytime they ever pause, they usually don't raise again. We've been paused since August of last year. January would basically indicate 5 months of pause, and then we would expect some cuts. Another metric that we have not looked on this channel yet, but we're going to go over today, is the Fed's balance sheet. So you guys can see, as a result of the pandemic, they basically had about $4 trillion on their balance sheet, and then it just absolutely moonshot up to $7 trillion, and then it just kind of kept going up to roughly about $9 trillion. Jay Powell talked about that today. He said something about basically wanting to get it back to where it's above their sustainable levels, pretty much is what he was saying. Where exactly that would be, it's hard to say. I would say maybe possibly maybe somewhere in between here, maybe like around 6 billion, or sorry, not 6 billion, 6 trillion, 6.5 trillion, somewhere in there. I would say maybe would be sufficient for them. It's hard to say. I mean, nobody really knows what that number is except the Fed, but probably a median somewhere between where it's sat here for a long time and where the peak is, I would say. So the thing that I want to talk about in this video that I think is the most important piece is what we expect going forward. So a lot of people are probably wondering, well, why don't you just invest in dividend paying stocks? Why don't you just invest in crypto? Why are you invested in like a bunch of different things? It's pretty simple. We are investors and traders, so we approach these markets, especially in current times, from a psychological perspective. What do I mean by this? Well, basically, what that means is if we're going to put ourselves in a position, what happens if the opposite comes true? So, if we're bullish on the markets, but then the markets tank, how can we put ourselves in a position where if the markets tank, we don't get completely destroyed by the bear market, right? So I'll give you an example of what I mean. So we have a certain percentage in crypto. We have a certain percentage in dividend paying stocks. We have a little bit, we've kind of scaled out of our positions of swing trades, but we have a little bit in swing trades still. And we have a certain percentage of our portfolio in cash. So why is this? Well, it's quite simple. We think that the markets are going to be bullish. So we have, I'd say, probably about 50-60% of skin in the game to the long side. And we have cash on the side, roughly about 40%. In case there is a bear market, we have plenty of cash to be able to buy the dip. So these are basically what we're doing here is a double hedge play. The reason being is because we cannot be sure how long it's going to take the Fed to cut rates. We can't be sure when the yield curve, as you guys can see here, is going to uninvert. It still has not uninverted, even though rates on the 2 and 10-year have dropped substantially. And we do not know for sure, 100% certain, if when the Fed cuts rates and the yield curve uninverts, that the markets are not going to dump. Because historically speaking, the majority of the time when the Fed cuts rates and the yield curve inverts, the markets do have a massive drop. They usually go down like, I think it's an average of 20-25%, somewhere in there. It could be more, it could be less. We really don't know. But historically speaking, the Fed cuts and the uninversion of the yield curve does favor the bears. So we don't want to be 100% long and 100% risk on if that happens. And that's another reason why we're diversified, because if we're diversified and the markets do dump, then the pain of the drawdown is not going to be as significant as if we were concentrated into just a few positions. So understanding market psychology and what history has, basically how things have performed based on history and prior times, is very important when it comes to investing. Most people don't want to take the time to do that or look at that. That's fine. Don't be shocked when your portfolio goes down or gets dumped on, and then you're like, oh, what the heck? I just lost 20, 30, 40, 50% of my portfolio. Well, if you guys had been following this channel and been, not financial advice, but if you guys had been trying to learn some of the stuff that we're trying to teach you here, financial education, as it were, then you would understand very clearly why this is so important. Now, if the Fed comes out and starts cutting rates, the yield curve uninverts, and the markets just continue to go up for a bit, I would say at least halfway through through the rate cuts. If the markets go up as a result of that, which we think is going to happen based on the bear market seemingly of last year, seemingly have priced in the rate cuts and all that stuff. Basically, all of the bearishness got priced in last year is what we think is going on, and the markets are going to rip next year, regardless of whether the Fed cuts rates and the yield curve inverts. If that happens, then we'll probably start moving more heavily into risk on assets. But as for right now, we're just DCAing in, maintaining a certain amount of cash, and we're just going to keep on doing that and be patient and move in ebb and flow with the Fed until we know for sure with more certainty of what's going to happen with the markets and the economy going into the Fed rate cuts. So that's the reason why we're not fully concentrated in one thing or another. We could just put it all in crypto, put it all in stocks, put it all in cash, but there's risk in either direction. If we put it all in cash and the markets go up, well, we missed out on the opportunity to make money. If we put it all in stocks and crypto and the markets get dumped on because, historically speaking, Fed rate cuts and the uninversion favors the bears, then, well, it would really suck to not have some cash on the side. On top of that, the risk on assets would go down in value. And we don't want to put ourselves in a position where we have to sell for a loss unless we absolutely have to. So, and we have not had to do that, thank God. It's one of the benefits of, being 1 foot in, 1 foot out of the market, so to speak. So anyways, this is our update on the FOMC meeting. Just so you all know, basically what we expect to happen for 2024, we think the Fed's going to cut rates by March of next year. We think they're going to cut rates by at least 6 to 8 cuts next year. It could change. It could become a lot more by the time they do their first cut next year. This is always changing. It's not set in stone, just so you all know. We do expect the yield curve to uninvert when that when that happens, or maybe even before it does. Excuse me. And we do expect the markets to melt up, or basically to continue to push into new all-time highs for the entirety of 2024. That's what we expect. Again, we say that because the bear market was absolutely destructive last year, and we have not seen something that's brutal drawn out for that long like we did last year, basically for the entire time that we've been investing over these 7 years. So anyways, hope you all enjoyed this content. Please like, comment, and subscribe, and we will see y'all later. Peace.